Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, as we always do, let's focus on the precious metals and let's focus on this correction that we're going to. The correction that really started at the very start of February. It was after about a 4-month run in the precious metals where gold got up to about 19, let's call it 70. And then now it's down to, as we're recording, 1845. We're hearing a lot about how a correction was needed and warranted, but we're also hearing a lot about how this could be a healthy correction, even after gold gave up $100 in a matter of just under 48 hours. What's your take on this correction? Is this a healthy correction?
Well, I think that if we step back, and I may have mentioned this in recent weeks, apologize if I have because I'm going to repeat myself, but if we look at gold's coming out of significant bottoms, like you look at 1976, 2008, 2018, 2019, when gold is at the beginnings of an impulsive advance, it's making a rebound. When you're in a real new bull market at that point, the pullbacks initially in the first year or so, they can be just brief and they're not that significant in terms of the decline. I mean, the most I've seen in a lot of examples, 2008, I mean, you had at some point you had a 10%, I think a 12%, but gold went from 700 to 1,000 in 4 months. So that's why you had those kind of pullbacks. But even aside from that, really the most you see historically is like an 8 or 10% decline. So if gold can hold around 1,800, then if that's the next bottom, it turns up and things are looking bullish, then to me, I guess you could say it's a healthy correction. But I mean, I guess my point is, it's kind of obvious, but if the new bull market has started, you're not going to correct a whole lot. And so, looking at the miners and the way that they've come down, looking at silver, which has rolled over badly, I think there's fundamental reasons behind this correction, which is, bond yields are moving higher. You have some expectations of a little bit more Fed tightening. So the dollar's rebounding and rallying again. So this is not like, if you're a precious metals bull, this doesn't look to me like this is a healthy correction, because again, a healthy correction would be you're in a new bull market. And because of that, you only correct for a month or two. It's not that deep. Then precious metals turn up again. So I think, we're getting into the weeds here of this, but that's just the reality, is that if you're in a new real bull market at the beginning of it, the pullbacks are really, they're really brief and they're not too deep. And so I don't think that we're going to make new lows here in precious metals. I'm still very bullish over the next, 6, 9 to 12 months, but I do see some struggles here over the next month or two. And, we could see gold go below 1,800, and, we could see silver and the miners, they could correct even more and come down not too far from the recent lows. I mean, that's possible. It just kind of irks me when I hear just these comments. Oh, well, the market was overbought, and this is, you needed this correction. It's a healthy correction. That's the other thing. Like when you start a new real bull market, the market gets overbought really early, really fast, and then it doesn't correct a whole lot. So I guess my point is, based on this action, it looks to me like we're not starting a bull market yet at this point. And I mean, it's becoming a little more obvious now, but that's just what I wanted to say about all this.
Well, Jordan, let me unpack it a little further with you, just because I'm sure there's some other people thinking the same thing. We did see a couple months run in silver before it rolled over where it was really overbought and stayed overbought. I mean, it did go from 1740 up over 24 to like 2475. So it was a pretty good run in silver. Same thing in gold. It took a little while to get going. Same thing in the mining stocks. But when they did go, GDXJ shot up pretty high. They went up 50%. They did outperform the metal in that sense. A lot of the individual miners went up 100%, 150%, some of the, the more liquid names, or so the more followed names. And we saw gold shoot up $400 at one point, from 1618 up to 1975, almost to 2000. So people were saying, hey, it has gone up pretty quick. Isn't it due for a correction? I guess if we drew a line in the sand, you said 1800 is a level you want to see hold in gold. I know a lot of people are looking at 2150 in silver. We don't want to see it really break down, but if it was to kind of base around this area and then move higher, what would give you confidence that we are still in a good bull market run, and that maybe this was all the correction we needed?
Yeah, you would really, 1800 is really the line in the sand for numerous reasons. If you look at these percentage declines, I think a decline down to 1800 is about, I don't know, maybe 8-9% or so from the peak. So that's one thing. So based on the history, that's one level. But also, if you look at the 200-day moving average, the 400-day moving average, and there's reasons why I use both those. And then also the 40-month moving average, which if you look at gold over the last 50 years in a monthly chart, you can see how significant that is. All these three moving averages, they're filling in around 1800. And at the same time, a 50% retrace of the rebound would be about 1800 or so. Maybe it's a few dollars below. If you look at what happened in 2018, that rebound, the small correction in 2019, I think it was about 6 or 7%. And that correction only retraced 50% of the preceding rebound. So there's all these, everything you're looking at says 1800 is the key level. So that to me, if gold is able to hold above 1800, maybe it doesn't make a monthly close below 1800, holds above it on the weekly chart as well. That to me would be pretty bullish, especially at the same time if gold is strengthening in real terms, like it starts to regain outperformance against the stock market and foreign currencies. That would be bull market action. But with that said, even if gold were to break below 1800, that doesn't mean that the larger bull thesis is, you have to throw that out the window. It would just mean that, this period of correction would last, longer than we initially had hoped for.
So, from what you said, we're not going to the lows. You don't think gold is going back to the lows of, say, the 1600s or just above 1600s, but you're not that encouraged by this correction. So, overall, are we in a range-bound trade and your bullish thesis simply is getting pushed out to a later date?
Yeah, that's what I would say. Because remember, and this, again, we talked about this last week, this is why you have to look at the macro fundamental picture along with technical. You can't just, someone will just look at the charts and they say, oh, well, that's obvious, gold, that was when it, broke out right there. That's when you wanted to buy. It's like perfect in hindsight, but here and now, if we're looking at the macro fundamental drivers, my bullish thesis has been based on, the economy will roll over at some point and the Fed will probably have to cut. Well, if you look at developments in the last, month or two, the stock market is veering off from my mega bear market path. If you look at bond yields, those have been, they didn't break down. Those have been starting to break up a little bit. So you look at the message of the market now and the macro, and that it's, even though I don't really believe in the Fed, higher for longer, they're never going to cut. If you look at the most recent data in the most recent price action in markets, they're telling you, at least for the next couple of months, those narratives will prevail, where you have higher bond yields, and more concern about inflation, and the Fed might have to hike to 5.5 or 5.75 or whatever. That scenario, again, which is going to prevail for at least the next couple months, it looks like, that's not bullish for precious metals. So you think about that, and then you align that with the price action. It makes sense based on your question that yes, it's going to take longer. And if you look at, I did a video on this, the gold cup and handle. It's still really well intact from a bird's eye view, but gold could come down for 1, 2, 3 or 4 months, 5 months. Maybe it struggles for that period until these macro headwinds for gold until they change. We need to see a situation where the narrative is more recessionary, and the Fed having to cut rates, or maybe it's recessionary but there's stagflation and the Fed's hands are really tied. That's the kind of, you need one of those two narratives for gold to really begin a bull market. And so with respect to the next month or two, we're just not going to see that. And that's why it's reflected in the price action of precious metal. Why the miners are selling off so aggressively, why silver rolled over so badly. it all kind of makes sense. So yes, I mean, the message of the market and the macro right now is that this is going to take gold longer to break out. It's not going to happen in the first half of this year.
Well, Jordan, I think that when we were talking in December and January to you and even to other guests, we had brought up the fact that, hey, look how far the dollar has fallen, and that the 10-year had really pulled back. And those are some of the key things that were helping the precious metals plow forward. But when we saw silver get stuck starting at the end of December and moving through January, not really being able to advance, and we saw the mining stocks start to slow down, that was kind of an early tell that things were slowing down and that they may roll over. And we kept asking people, what do you think is going to happen when the dollar bounces? What do you think is going to happen when the 10-year yield starts going again? Because the Fed is going to hike in the first quarter once or twice, and that's what's happened. So I don't think it's a big surprise how it's played out, but when you look at the general stock markets, your main indicator is the gold versus S&P ratio. And are we seeing precious metals outperform the equity markets in real terms? And so I guess when you look at the general markets, how do you see the S&P 500 or the Dow or the U.S. equity market set up right now? Are they getting ready for a potential bull run, or are they also in danger of rolling back over?
Well, I think, again, just focusing on the next month or so, the path of least resistance for the stock market is up, and for precious metals, it's down. So gold against the S&P ratio in a very short-term sense looks weak. If you look at the chart of the S&P 500, just the recent price action, it looks like it's kind of in a bullish consolidation here. So, if the S&P moves above 4,200, it's probably going to carry it a little bit higher than that. In addition, if you look at the breadth thrust that we've seen in the stock market, there's a lot of people who only look at technicals, and I'm talking about real technicians, not people who just throw up charts on Twitter and draw a bunch of lines, but real technicians who study the history and these breadth indicators. There's a lot of breadth thrusts that are just based on breadth thrusts. These guys are saying, oh, well, this is a new cyclical bull market, even though they're not looking at anything else. So based on that, I mean, there is more upside here for the stock market. I mean, the one of my favorite strategists, who I think has an excellent track record over the last 20 years, even 6 months ago, his call was the S&P is going to go to 4,400, and then a recession is going to hit in the second half of this year, and the S&P can go to the low 3,000s. I mean, it is kind of interesting that you do have these breadth thrusts, which are saying you have a new cyclical bull market, but I really don't see that happening. I do see, again, potential for more strength here in the next month, and that, and again, this is negative for precious metals. The stock market's rebounding and going higher, and more money's going in there. That's negative for precious metals. But I do think if you're looking at the macro and you're zooming out 3, 6, 9 months from now, the economy could get into a difficult situation where, if inflation doesn't come down to, 3 or even 4%, and the Fed has to hike to, like, let's say even 6%, the odds of a hard landing, the more they have to continue to tighten, the odds of that are going to increase. And it's just a question of timing. And again, if you look at the yield curves and you look at the average or the median time of when they invert and when the recession hits, if you're looking at the average and median time, that doesn't even hit until like the middle of the year, or July, or even August in some cases. So we're still too early to expect the recession to hit. It hasn't, that's one mistake that I made in the past. It's still too early for that to hit. It's not going to come about until middle of the year or a little bit later. And so, that could be the point when, if the recession hits, then you'll get some, downside pressure on bond yields, and then you have the bullish catalyst for gold. So I think this is why you have to marry the macro with the technicals as well, because the timing, if we're looking at the message of, precious metals are weak right now, stock market is strong. So consider that, and then consider what the inversion of all these yield curves tells us, that it could be a situation where it's going to take more time for the economy to really roll over. So again, I think that's what's being reflected right now in the price action of all these markets.
All right, Jordan, we'll wrap it up here. A lot to take in, and look, we're still early on in this correction. Who knows how deep this correction is going to go? It's come at us pretty quickly here, and there's still a lot of levels for us to watch and some key moving averages to also watch, as you outlined for gold, around that 1800 at least initially. So Jordan, we'll chat again next week. We'll see where this market is at that time. We do appreciate your outlook, though. Thanks for taking time with us today.